It's been an eventful and at times quite volatile year in the markets. Where do we stand today?
Absolutely. Thanks, Holly. I really appreciate it. Let's begin by setting the stage for what has been a remarkably resilient year for markets throughout 2025, particularly in the face of macro uncertainty on all fronts, whether it has been tariffs, fiscal or monetary policy domestically, or geopolitical tensions abroad. The first slide shows equity markets continuing their strong performance for the third consecutive year, and this is despite significant volatility early in the year around Liberation Day. Developed international and emerging markets are leading the way, up more than 20% year to date. As mentioned during the last webinar, much of this outperformance is reinforced by dollar weakness, which has boosted foreign returns and encouraged investors to diversify globally. Domestically, US large caps remain leadership, up about 15% year to date. However, performance is more balanced than in prior years. Small caps led in 3Q as markets begin to price in a series of rate cuts following July's softer jobs report. From a sector standpoint, leadership has broadened as well. Growth-oriented sectors like communication services and technology continue to outperform, but we're also seeing strength in traditionally defensive areas like utilities, and even cyclical value sectors such as industrials, financials, and materials. Bond markets have performed well too, delivering mid-single-digit returns. Investors are benefiting from historically attractive coupons, while losses remain limited thanks to strong corporate fundamentals. These are driven by growing cash flows and low capital costs locked in prior to the Fed's previous hiking cycle in 2022.
We've certainly seen a powerful recovery since those April lows. As you look ahead, how are corporate fundamentals panning out at this point?
Yeah, absolutely. This is where we really have to separate the noise from the data. This chart demonstrates the strong corporate profit backdrop we have been operating in. The chart displays trailing 12-month S&P 500 earnings on a quarterly basis going back to 2023. The dark blue bars show actual earnings results, and the lighter blue bars represent consensus estimates through 2026. Both sets of bars are shown in dollars and correspond to the left-hand axis. The green dashed line illustrates a steady upward trajectory of the year-over-year earnings growth rate on the right-hand axis, with earnings projected to grow 11% in 2025 and accelerate to 17% in 2026. In addition to the headline of accelerating growth in 2026, there are a few key takeaways here. First, the market's resilience in the face of uncertainty this year has been justified given the upward trajectory of earnings results. Through the emotional ups and downs, corporate America has really found a way to deliver. Second, year-over-year earnings growth is expected to stall in the back half of this year as companies grapple with lingering trade disruptions and rising input costs. In addition, while the secular AI and data center CapEx trend continues to be the largest contributor to absolute growth, the rate of growth for the so-called Magnificent Seven, which we've discussed in previous updates and include Microsoft, Apple, NVIDIA, Tesla, Google, Amazon, and Meta, are expected to decelerate. This turbulence in earnings growth could certainly cause volatility into year-end, but a case can be made for cautious optimism as analysts anticipate a re-acceleration in earnings next year, and more importantly, a broadening of that growth beyond just the Magnificent Seven.
Tim, what will it take for this continued growth to continue in corporate earnings?
Yeah, Holly, I think for growth to continue, we'll need to see it expand beyond the concentration in the Mag 7. This chart compares year-over-year earnings growth for the Magnificent Seven in dark blue versus the remaining 493 S&P stocks in green. In 2025, most growth has been concentrated in the Mag 7, while the rest of the index shows modest growth. As we enter the third quarter earnings season, forecasts are beginning to shift. Analysts now expect earnings growth to broaden, with earnings per share estimates for the remaining 493 stocks starting to converge with and eventually outpace the Mag 7 by mid-2026. The next slide provides some context for this transition as well. Traditionally, the consumer, shown in green, has been the backbone of the US economy. The far left column shows the average contribution to growth from 2000 to 2019 and is clearly dominated by the green segment. What's striking this year, as shown in the far right column, is the dark blue segment, non-residential investment. This is now the largest contributor to GDP growth in 2025. Non-residential investment is economists' fancy term for corporate investment. So far in 2025, the increased contribution from this factor has been almost entirely driven by AI spending, running at nearly 3 times the long-term average. A key assumption underlying the broadening earnings forecast discussed on the previous slide is a normalization of the long-term trend driven by a resilient consumer. As the forward-looking market's gaze shifts to 2026 and the evolving earnings backdrop, we feel it prudent for clients to have balance within their portfolios and exposure to the market segments with improving fundamentals.
So, Tim, this idea of this broadening out has been a bit of a perennial storyline. What might change in 2026 to really bring this to fruition?
Certainly, consensus earnings forecasts have some volatility around them, and historically, estimates for the Mag 7 have held up, while broader market projections have tended to fall short and be revised lower as the year progressed. As we look ahead, there are 2 important catalysts that could support a more inclusive earnings backdrop in 2026. First, the administration's One Big Beautiful Bill Act has injected substantial fiscal stimulus. Companies will benefit through increased deductions for R&D and capital spending, while consumers will benefit through lower income taxes and potentially higher refunds in early 2026. Second, proposed deregulation, particularly in financial services, could boost liquidity and help lower rates by increasing demand. This fiscal support, combined with easier monetary policy, which John Finkler will cover shortly, should benefit sectors outside of technology, including industrials, financials, and consumer discretionary.
So these are important tailwinds, but there's certainly some cautionary flags out there as well. One we talk about quite a bit is valuation. How are you looking at valuation metrics right now?
Yeah, valuations are definitely one of those cautionary flags. I'd be remiss if, after covering the fundamental backdrop, I did not acknowledge the valuations across many market segments, both equity and credit, remain elevated, reflecting optimistic expectations. My final chart highlights historical valuation ranges spanning the last 20 to 30 years, depending on the asset class. The blue shaded bars show the valuation range over time. The dots represent the current reading, while the triangles represent the 5-year average valuation for each asset class. US large cap equities are sporting valuations near the top end of the historical range. An important item to note is that valuations have not been a great market timing tool when you are looking at short-term results. The chart also underscores how persistently elevated these valuations have been, with trailing 5-year averages still well above the long-term multiples and only slightly below current levels. The bottom line is that the highest valuations remain concentrated in the hands of the largest and growthier pockets of global markets. As the earnings backdrop continues to evolve, future investment opportunities may increasingly lie in the diversity of the investment universe rather than in the concentrated hands of a few magnificent stocks. That's why we at Bartlett continue to emphasize balance and diversification across asset classes and market segments. We remain vigilant to ensure our portfolios are well positioned to navigate an uncertain market environment.
Tim, thank you for that deep dive. And as I think about what we just heard from you, it really does depend on the health of the consumer as we look forward in this idea of broadening out beyond a concentrated part of the overall markets. James, let's turn now to you and talk a little bit more about the US consumer. How are you thinking about the consumer and in turn the overall health of the economy?
Yeah, Holly, these are obviously issues that have certainly been on the forefront of my mind. Keep in mind, movements in the stock market, well, they've been historically driven by the health of the economy. As Caitlin said and Tim has said, we at Bartlett, well, we're focused on building all-weather portfolios and strategies that balance risk with opportunities. So let's getting back to the consumer. Historically speaking, 70% of U.S. GDP growth has been driven by consumer spending. While Tim pointed out that 2025 has been an outlier, a different story, where that is focused on business and investment spending on AI, it is still crucial to recognize the importance of a healthy consumer when talking about future economic growth. So with that point, many factors, economic, psychological, and social, drive consumer spending growth. One major influencer of spending growth is disposable income. For most Americans, the main contributor to disposable income is employment. Think about it this way. Job and job security not only impact the ability to spend, but also the psychological willingness to spend. Employment provides the income needed to support consumption, while job security influences the confidence needed to spend. So let's take a look at the job market, looking at using the economic indicator non-farm payrolls, which is a key indicator of economic health. Put simply, it measures jobs added or lost, excluding the seasonality associated with farm employment. The change in non-farm payroll is represented by the blue bars. The dotted green line shows the long-term average of 130,000 jobs added per month since 1950. So going back to 2022, as this chart displays, the job market has maintained substantially above trend due to benefits of COVID-era stimulus. Since the start of 25, though, the number of jobs being added has slowed meaningfully. Economists have cited two reasons for the slowdown: tariff uncertainty and lower immigration. While the slowdown is certainly a reason for caution, determining whether this trend is simply a cool down from a hot labor market or a more meaningful slowdown, well, that remains unclear at the moment.
James, what other factors beyond payrolls are you paying attention to?
Yeah, well, as I said, job growth is critical, but there are other factors that must be considered, including productivity enhancements and wage growth. As our colleague Matt Stith discussed in the latest strategy update, AI is beginning to drive measurable productivity enhancements as companies integrate new technologies into their operations. Walmart's a good example. They recently announced it expects to keep employment roughly flat over the next 3 years as technology advancements are progressed. The chart on the left side of this slide shows the most recent productivity reading from the Bureau of Labor Statistics. In Q2, productivity reading was 3.3%. This was well above the long-term average of 2.1%. While earlier gains have been promising, the broader economic impact of AI adoption will likely unfold gradually. Encouragingly, real wage growth has become a supporter factor for consumer spending, as indicated in the chart on the right side of the page. Private sector employees have experienced inflation-adjusted wage gains since mid-2023, following a 2-year period of declining purchasing power during the post-pandemic inflation surge. With inflation now moderating and incremental productivity gains emerging, households are beginning to see modest but steady improvements in their real incomes, and this should help sustain consumer demand even as labor markets cool.
So, James, there's been a lot of talk recently about this idea of sort of two different economies. When you think about the wealth effect and how the top 10 to 20% of income earners are really driving growth, how does this impact your views of the health of the consumer?
Yeah, I mean, it's a commonly cited concern is how bifurcated spending is amongst income groups. Here in this chart, you can see the top 20% of income earners, represented by the red line, have been basically carrying the load of consumer spending growth since 2023. Meanwhile, spending among the remaining 80% of income owners, well, that's been flat. This is primarily due to the wealth effect. Higher income cohorts have greater exposure to financial assets such as stocks and real estate. The values of these assets have appreciated considerably, bolstering household wealth and confidence. Now, contrarians question whether this trend can continue. And while we cannot predict the future, the wealth effect appears to be intact. The top 20% also possess diversified portfolios, and this should help provide protection against market drawdowns. Meanwhile, output from the remaining 80% of income owners, it's not expected to decline really meaningfully. So the bottom line is that the wealth effect is well positioned to continue fueling future consumer spending growth.
When I put those together, James, I hear we have a bit of a softer labor market, still some unknowns around inflation, yet there are opportunities for productivity employments and certainly some heavy lifting from those high income earners. Given these dynamics, are there certain sectors or stocks that you like?
Yeah, sure. In the consumer space, Holly, there's a number of stocks that we like to highlight. As in my opening remarks, the American consumer, well, it's an important component to the economy. Consumer activity may slow in the short term, but it is expected to remain resilient. And that's why we at Bartlett own a diversified mix of consumer-related stocks. Our portfolios own defensive businesses complemented by some cyclical or economically sensitive names. Our defensive lineup, well, that includes TJX companies and Costco. TJX is an off-price retailer. They operate TJ Maxx, Marshalls, and Home Goods, and they basically sell name brands at lower prices than what you can find at the department store. This value proposition, well, it resonates with all demographic groups, particularly when incomes are getting squeezed. Now moving on to Costco. Well, Costco product mix consists mostly of grocery-related items. The retailer also sells in bulk, which is a strong value proposition to shoppers. Costco also benefits from a membership-based business model. Membership renewal is consistently around 93% and typically unaffected by economic conditions. One last consumer stock that I like to point out, or at least highlight, is Amazon. It's a go-to business considered to be core, largely because it possesses both defensive as well as cyclical attributes. From a defensive perspective, Amazon benefits from the Prime membership model, as well as the sale of everyday goods. This provides visibility into the future of earnings growth. The economically sensitive side, well, it includes the sale of discretionary items as well as advertising. And what's really makes Amazon unique is these businesses, well, they're complemented by a presence in AI with AWS or Amazon Web Services. So looking at this, at the end of the day, these three consumer stocks align with our continued focus on building all-weather portfolios for our clients. So what does that mean? Well, it means we are well positioned whether the economy and the consumer begin to show weakness, maintain steady growth, or the most optimistic AI forecast materializes.
James, thank you for that deep dive into the consumer experience.